dot-com bubble in 10 seconds. As the internet became popular, investors put their money into new internet-based companies, causing explosive stock growth. When reality hit that many of these companies had no chance to actually make money, the stock prices crashed, deleting trillions of dollars of market value. The dot-com bubble in 1 minute. In the mid to late 1990s, everyone was going crazy for this new thing called the internet. Investors were throwing all their money at any company with .com in their name, regardless of whether they were actually making money or even had a real business plan. Some companies even changed their name to add .com just to get in on the hype. Some examples are like Pets.com. They sold dog food online and burned through $300 million while getting their sock puppet mascot at the Super Bowl, but not making any real revenue. Companies were valued at billions despite never turning a profit and sometimes not even getting revenue. The Nasdaq, packed with tech stocks, skyrocketed from 1,000 points in 1995 to over 5,000 points at its peak in March of 2000. Then reality hit. These companies weren't making money and many never would. The falling crash was brutal. From the peak in March of 2000 to the end of 2002, the Nasdaq lost 78% of its value. $5 trillion in market value gone. Hundreds of companies went bankrupt, hundreds of thousands of people lost their jobs, and the economy entered a recession. Turns out that you actually need a business model to succeed. Now let's do the dot-com bubble in 10 minutes. Let's rewind to the mid-1990s. The internet is becoming mainstream and Wall Street is salivating over the possibilities. This isn't just another tech trend. This is supposedly going to revolutionize everything. Shopping, communication, business, life itself. In 1995, Netscape went public. For context, Netscape created Navigator, the first web browser that made the internet accessible to regular people. So think of it as like the Google Chrome of the 1990s, except most people had never even used the internet before. The company had barely any revenue, but its stock price doubled on the first day of trading. This sent a clear message to investors and entrepreneurs. Internet equals instant wealth. And suddenly, every business plan needed a .com strategy. Traditional metrics like price to earnings ratio, forget about it. Revenue, who needs it when you have eyeballs and page views? The new metric was how fast you could scale and capture market share in the digital economy. Venture capitalists started throwing money at anyone with an internet idea. Got a website that lets people buy socks online? Here's 50 million. Want to create an online marketplace for trading baseball cards? Take another 30 mil. By 1999, the madness reached peak levels. Companies were going public months after being founded, and because investors didn't care about profit, startups were doing anything, and I mean anything, to increase revenue. For example, Pets.com, the infamous online pet supply company, went from startup to IPO in just 2 years, raising $82.5 million despite losing money on every single sale. But because they were actually getting sales and revenue, investors kept investing into the company. Another example of the hype, the Globe.com stock price jumped 606% on its first day of trading, the largest first day gain in history at the time. The company had revenue of just $2.7 million, but was suddenly valued at over $800 million. Because of all of this, day traders were quitting their jobs to trade tech stocks from home. People sold everything and got mortgages on their homes just so they could invest more into the market. Everyone had their own hot stock tip. CNBC became must-watch TV. The phrase, "it's different this time," was everywhere. The internet had supposedly broken all the rules of traditional investing. And for some people, it paid off. The Nasdaq Composite Index, heavy with tech stocks, went parabolic. It rose from about 750 points in 1995 to over 5,000 points by March of 2000. That's a 567% increase in just 5 years. Now, before we talk about the actual crash that happened, let's talk about some of the most notorious players in the game at the time. Everybody's favorite company, Amazon, survived the dot-com bubble, but even Amazon saw its stock drop 94% during the crash. The difference was that Amazon actually had a real business model and kept expanding after. Another example that we talked about was Pets.com, the poster child for the bubble excess. They spent $2.2 million on a Super Bowl ad featuring their sock puppet mascot while they were losing money on every transaction. The company went from IPO to bankruptcy in just 268 days. One company which actually had a decent idea, called Webvan, promised 30-minute grocery delivery to its customers. It was a lot like Instacart is today, but the problem was that they held all of their food supply within their own automated warehouses, and they built massive warehouses before even proving that the business model would work. Nowadays, things like Instacart, they just get the food that's already in the grocery store to your house. So they had a decent business idea. It was just not the right time. And there was definitely a lot of aspects that they could have fixed. They raised over $800 million and went bankrupt before 2001. One last example of the craziness is called Cosmo.com. They delivered snacks, movies, and magazines in under an hour in major cities. They had a great service, but terrible economics. They were essentially subsidizing the customers' purchases with the investors' money, which just kind of shows you how crazy the times were. But there were definitely some warnings that people could have paid attention to. Smart investors like Warren Buffett were warning that these valuations made no sense. Buffett famously avoided tech stocks during the bubble, saying that he didn't understand them. He was mocked for being old-fashioned, while everyone else got rich on paper. Here's a list of some of the key warnings that were ignored. The first is that companies with no revenue were being valued at billions. The second is that price to sales ratios were at 30, 50, or even 100 times. Third, executives were also cashing out of their shares while telling their investors to hold. They knew that their companies had no chance of being profitable. Fourth, business models that required unlimited cheap capital to survive were the ones that were blowing up the most. And the biggest warning sign was that profitability doesn't matter in the internet age. This belief is totally different from the traditional rules of investing. And many people fell into this trap because of how amazing they thought the internet was. And this kind of stuff happens in the past as well. Like this happened with cars, this happened with television and radio. This kind of stuff happens all the time. And we actually need to remember them so that we can learn the lessons from our predecessors. Now the actual crash. The party started ending in March of 2000. The Nasdaq peaked at 5,048 points on March 10th, 2000. From there, it was a long, brutal slide down. So what actually triggered it? There's a multitude of factors, but there was rising interest rates, concerns about inflation, and gradually, investors started asking the uncomfortable questions. When exactly will these companies actually make money? So the crash happened in phases. The first phase was from March to May of 2000, and this was just an initial correction as the overvalued stocks started falling. The second phase was in 2001 after 9/11. The 9/11 attacks accelerated the decline and pushed the recession even faster. And the last phase from 2001 to 2002. The full extent of the corporate fraud and the fake accounting became very clear, and that caused the final amounts of insane losses. By October of 2002, the Nasdaq had lost 78% of its peak value. The broader S&P 500 fell 49%, and over $5 trillion in market value was wiped out. But behind just numbers were real people whose lives were destroyed. Hundreds of thousands, if not millions of Americans lost their jobs as tech companies folded. Retirement accounts were decimated. Many people had their life savings in tech stocks and they lost all of that. Entire cities like San Francisco saw a mass exodus as a tech boom turned to bust. And the unemployment rate jumped from 3.9% to 6.3%. The dot-com crash led to a recession that lasted from March to November of 2001. It took 15 years for the Nasdaq to return to the peak of the bubble once again. But here's the thing, the internet revolution was actually real. The timing and valuations for some companies were just completely wrong, but other companies like Amazon, Google, and eBay, they survived and became some of the most valuable companies in the world. These survivors had a few things in common. The first was that they actually had real business models that could eventually generate profit. It did take a while for some of those companies, but they eventually did make it. They also had strong management teams, and they also had enough cash to survive the downturn during the crash. But the most important thing that they actually had was that they had products or services that people actually wanted and would pay for. And because of all these factors, they were able to survive after the bubble burst. But aside from the companies, one of the most amazing things that happened because of the bubble was that because there was so much infrastructure being built for the internet and internet providers were always updating their infrastructure during the time, this actually led to the internet becoming more accessible and more cheap for more people in America to actually use, which I guess also helps the surviving internet companies as now more people actually have access to their services. So what can we actually learn from the dot-com bubble? The first is that fundamentals always matter. Eventually, companies have to make money. And if they don't, all you're doing is gambling. The second is that bubbles always burst. When everyone thinks it's different this time, it usually is not. Third is that innovation is real, but timing and valuation matter. The internet changed everything, but it just wasn't as fast as investors thought it would be. And lastly, diversification saves lives. Don't put all your eggs in one sector's basket. Spread it out and spread the risk. The dot-com bubble stands as one of the greatest speculative manias in history. It showed how greed, FOMO, and the suspension of rational thinking can create and destroy trillions of dollars in wealth. But it also paved the way for the digital revolution that followed, just with better business models and more realistic expectations. So what do you think? Does this sound familiar? Let me know in the comments if you see any similarities to today's market. But anyway, subscribe for more business and money content.